We're going to look at one specific classification of investments in other corporations, and that's when we classify it as held to maturity, and this is only bonds. Now, bonds can be trading, bonds can be available for sale, or bonds can be held to maturity. You can classify it 3 different ways, but if your intent is to hold it until it matures, you have to classify it that way. Reviewing the different levels of influence. If it lacks significant influence, that means you're looking at owning less than 20%. It means you don't have the influence on the board of directors or management. And if that's the case, you will use the fair value method. Investment classifications are required into these 3 classifications. So trading securities, those are your rapid day trading things. Buy it today, I may sell it this afternoon. That has to be classified as trading. Available for sale, classification, if I invest in something, stocks or bonds, but I'm not necessarily going to hold, if it's a bond, to maturity, then I record it as available for sale. It does tend to be more long-term investments, though. Held to maturity is only bonds, and that is if I intend to hold it until it does mature. I have to classify it that way. Trading can be stock or bonds, as can available for sale. Held to maturity is going to be bonds only, and it is recorded at amortized cost. There are no fair value adjustments for held if your investment is classified as held to maturity. There are going to be 4 times when journal entries are required at the purchase: recording revenue, recording the fair value adjustments, and recording the sale. And remember that held to maturity is only bonds. This is an example if it's sold at if it's purchased at a discount. You might purchase at a premium, you might purchase it at par value. The initial purchase journal entry is no different than if this bond had been classified as either trading or available. Recognizing income, this is when you get interest, it's a bond. Interest investment revenue is where you're recording your interest, and you're amortizing your discount on bonds investment, just like the corporation on the other side is amortizing the discounts on bonds payable. It's just a mirror image. They have an expense, you have a revenue. This is different than recognizing investment revenue using the equity method. That's shown on a separate video. So if you have held to maturity and the markets rise, that means the value of your fixed interest payment is going to decline. If the market declines, that means the value of your fixed interest payment will rise. There's an inverse relationship with bonds to the stock market. Doesn't matter, though. No fair value adjustments are allowed if it's classified as held to maturity. You would do a fair value adjustment on this bond investment if it was classified trading or available for sale. When you sell it, simply take it off the books at what you get it for and remove the unamortized portion of either the discount or the premium if one exists. And the offset would be a gain or a loss on the sale. This is the realized. But remember, with held to maturity, there are no unrealized because you're not allowed to do fair value adjustments. So it's simply a gain as you're held to maturity. There will not be an end of the year fair value adjustment being made. And how does this affect the statement of cash flows? Well, dividend and interest for trading is operating, and buying and selling is operating. Available for sale, dividends and interest, it's both revenue. Anything on the income statement is going to be operating. But the cash flow for the actual buying and selling the securities, that's classified as investing on your cash flow statement. Held to maturity, same thing is available. How the cash flow is classified. Now, what if I change my mind? What if I want to move something? So let's say I classified something as held to maturity. Originally, I thought I was going to hold it to maturity, but then I moved it to trading. I'm going to adjust the unamortized portion to the current net income. And if I move it from held to maturity available for sale, instead of reporting it's going to net income, it goes into other comprehensive income.